Assalamualaikum warahmatullahi wabarakatuh. Bismillahirrahmanirrahim. Ladies and gentlemen, it's a pleasure for me to join you for this annual conference on Second ASNA International Conference on Education, Social Science and Technology. Today, I would like to discuss an unusual topic, namely the bridging the gap of income inequality. All economics policymakers have some distributional impact as a result of the measure they introduce. Yet until recently, such consequences have been largely ignored in the theory and practices in the monetary policy. Of course, central banks are not charged with the task of addressing inequalities in the distribution of wealth, income, or consumptions, nor are they dealing also the broader challenge of promoting economic justice for society and as a whole. This is certainly true of the role of national central bank, which they have been assigned and given a mandate to maintain price stability on the medium term. But particularly at the time of exceptionally low interest rate, a non-standard monetary policy measure, it is essential for us to be aware of all collateral effects. It is essential, including distribution ones, the potential economic damages to some part of a society, and the potential of other. So I would like to take this opportunity to explore some of the emerging evidence on the distribution effect of monetary policy. I will begin with a brief discussion on the rising prominence of the inequality as an usual of global and public concern. And I will also review what we are learning about the impact of low interest rate and non-standard measure on household finance. My main focus will be on the impact of monetary policy in addressing the gap of income inequalities. What is income inequality? It has recently re-emerged as a topic of wide public debates. From a central bank perspective, the most relevant aspect of recent works concern the assessment that monetary policy can have a sizable distributional effects. Indeed, inequality has been largely ignored in discussion of monetary policy, but this might be very challenging and keep changing. Let me start my slide. In this context, I would like to touch on the potentially negative impact of rising inequality on financial stability. For example, some non-least, the current governor of the Reserve Bank of India have argued that US policies to circumvent the consequences of inequality fuel financial instability ahead of the crisis. But while income inequality may have driven the credit boom that preceded the US subprime crisis, the comparative and historical evidence suggests that there's a little relationship between rising inequality and financial crisis. More generally, inequality is of interest to central banking discussion because monetary policy itself has distributional consequences, which in turn influence the monetary transmission mechanism. For example, the impact of changes in interest rate on the consumer spending of an individual household depend crucially on that household overall financial position, whether it is a net debtor or net creditors, and whether the interest rates on its asset and liabilities are fixed or variable. Such differences have macroeconomic implications as the economy overall response to policy changes depends on the distribution of asset, debt, and income across households, especially in time of crisis, when economic shocks are large and unevenly distributed. For example, by boosting first aggregate demand and second employment, monetary easing could reduce economic disparities. At the same time, if low interest rate boost the price of financial asset while punishing saving deposit, they could lead to widening inequality. Insofar, central banks have a technical, non-judgmental interest in the distribution of income and wealth in the society. For this context, I would like to share three potential channels by which more accommodative measure might affect inequality. The first is the income composition channel. The second is the financial segmentation channel. And the third is the portfolio channel. The first is the income composition channel. While most households rely primarily on earning from their work, others receive large shares of their income from business and financial income. If more expansionary policy rise profit more than wages, then those with claim to ownership of firm will tend to benefit disproportionately. Since the latter also tend to be wealthier, this channel should lead to higher inequality in response to more accommodative monetary policy. The second is the financial segmentation channel. If some individual and organization frankly trade in financial market and are affected by changes in the money supply before others, then an increase in the money supply will redistribute wealth towards these most connected to market. To the extent that households that participate actively in financial transactions typically have higher income, then this channel also implies that consumption inequality should rise after expansionary monetary policy shocks. The third one is the portfolio channel. If low-income households and tend to hold relatively more cash and fewer financial assets than high-income households, then potentially inflationary actions on the part of the central bank will represent a transfer from low to high income household. Again, this will tend to increase consumption inequality. The previous study by NBER outlined two further channels that tend to move inequality in the opposite direction in response to expansionary monetary policy. The first is the saving distribution channel, where the lower interest rate will benefit borrower and hurt saver. This is an interesting finding, because to the extent that saver are generally wealthier than borrower, this will generate a reduction in consumption inequality. The second is the earning heterogeneity channel. Earning from job are the primary source of income for most households that may respond differently to monetary policy. This could occur, for example, if unemployment falls disproportionately on low-income group. Evidence that suggests that labor earnings at the bottom of the distribution are most affected by business cycle fluctuation. So, if monetary policy reduces unemployment, it will also reduce inequality. In addition, the income composition channel could potentially lead to reduce rather than increase inequality as a result of expansionary monetary policy, because low-income households receive on average a large share of their income from transfer, and because transfer tend to be counter-cyclical, then its component of income heterogeneity could lead to reduced income inequality. To conclude our discussion for today, I would say that the monetary policy may give a very big implication in addressing income inequality. To conclude, we can see that the central bank has a clear mandate to deliver price stability, and that mandate does not involve policy aimed at the distribution of wealth, income, or consumptions. Nevertheless, we need to be aware that there are distributional consequences of our actions, and this may well be particularly significant at time of exceptionally low interest rate and non-standard measure. It seems clear that there are different effects on different parts of society. There is no clear evidence whether standard monetary policy has a dampening or intensifying effect on economic inequality. In a non-conventional monetary policy, however, in particular, large-scale asset purchase seem to widen income inequality. although this is challenging to quantify. Still, a central bank with a clear mandate to safeguard price stability needs to act forcefully when push comes to shove. This distributional side effect then need to be tolerated, but they clearly should not last too long. There are one more reason to recognize that the non-standard measure we have introduced have to be temporary. Thank you for your attention. See you again. Stay safe. Assalamualaikum warahmatullahi wabarakatuh.